After strong returns during the year, 2023 is ending on a high note with US stock prices rising, and this is a classic Santa rally. But the question is whether this rally is sustainable or whether it's going to leave us nursing regrets later on. Or in other words, is this a present from bad Santa? Now don't forget, if you do enjoy our videos, please do subscribe to our channel and like this video. So let's look at whether this is a bad Santa rally in a bit more detail. So what is a Santa rally? Now there is actually a technical definition of a Santa rally. This was created in the 70s by Yale Hirsch, and it was published in the Stock Traders Almanac, which is now published by his son Jeffrey Hirsch. And his definition is very much focused on that final week of the year, where he says that Santa Claus tends to come to Wall Street nearly every year, bringing a short, sweet rally within the last 5 days of the year and the first 2 days in January. Furthermore, he goes on to state that if Santa doesn't show up, if there isn't a Santa rally, then that tends to precede bear markets, or times that stocks could be purchased later in the year at much lower prices. Now, although there is that formal definition, most people just assume that a Santa rally means a rally in December. And I think it's kind of interesting to drill into the data behind that. But before we do, let me quickly show you what a box plot is, because this will be critical to understand the graphs I'm about to show you. If you want to summarize a distribution, then you use one of these box plots. Really all it does is to show you where most of the data is. So the typical value is shown as a horizontal bar, that's the median value, and 50% of the returns will be higher than the median, 50% of the returns will be below the median. What you also want to know is how dispersed those returns are, how much variability is there around that central value. And here the box tells you what you need to know. 50% of the returns are within that box. The bottom edge is the 25th percentile, below which a quarter of the values occur, and the top of the box is a third quartile, above which another quarter of the returns occur. So half of the returns occur within that box. Then you also have the maximum and minimum values, which are calculated based on the interquartile range. That's the difference between the third quartile and the first quartile, but don't worry about that definition. And of course you have really extreme values, which we call outliers. Those are represented as single circles on this distribution. So the median's a typical value, and the spread around that median is contained in the box. That's the key understanding. So if we look at the return distributions for the S&P 500, and we've broken it down by month, and we've gone back all the way to 1962. The first thing to notice is that most of the medians are above zero. So the zero line is here represented as that red line. And of course that makes sense, because most of the time stocks rally, they go upwards. So you would expect the center of the distribution to be above zero. But there's a very big dispersion around that. So if you look at the boxes, they often span zero. Some of the boxes below zero, some of it is above. But what's notable about December is that the first quartile, below which a quarter of the returns occur, is just about positive. So 3/4 of the time returns are positive in December, which is quite unusual. Compare that with, say, June, when the median value falls right on the zero line and the first quartile is well below zero. So while it's not true to say that it's a dead cert to buy stocks in December, what is true is that returns are positive about 3/4 of the time, which is quite unusual. What's also true is that the dispersion in returns is also quite small, so there's less uncertainty, if you like, in December. Maybe that's because Santa's come down the chimney and he's squashed the distribution flat. What's also interesting is to look at the same analysis, but for the FTSE 100, that's the UK stock index. Now this doesn't go back to 1960, it only goes back to 1984, but what's quite notable is that December's even more positive than it was for the US. So the median is well above zero for December in the UK, and the 25th percentile is also above zero. But what's also notable is that for the FTSE 100, the median return, or typical return, is also well above the value that it has for any other month. So Santa's much more active in the UK than he seems to be in the US. So what are the potential reasons behind the Santa rally? Because it doesn't seem to be obvious that it would happen. Maybe the most tenuous reason is just optimism. People tend to be happy over Christmas. Maybe that cheer extends into the stock market. Another potential cause of the Santa rally might be tax loss harvesting. People choose to close out losing positions in December and open new positions in new stocks, and maybe that's sufficient to put up the overall stock market. I think a more plausible explanation is that people get paid a bonus towards Christmas time and they're investing that money into the stock market. So it's new money coming into stocks, which pushes up prices. But certainly whatever happens, there's going to be lower liquidity usually in December when markets have more thin trading. That means that a trade of given size is going to move markets more up or down during these periods of low liquidity. But like a lot of these phenomena in stock markets, it's simply an empirical observation. We can try and come up with reasons for it, but it's something that typically just happens. I think what's different in 2023 is that Jerome Powell is very much cast into the role of Santa. And in his December press conference, Jerome Powell said that there have been 3 stages to this cycle of monetary tightening. The first stage was simply to decide how quickly to hike, and the answer was very, very quickly. So they raised rates by 5.25 percentage points in a very short space of time compared to history. The second stage, which is the stage that they're in right now, according to Powell and other members of the FOMC committee, asked the question, is the current rate sufficiently restrictive to get inflation back down to 2%? And that's not an easy question to answer because monetary policy operates with a lag. So you have to raise interest rates until you think it's kind of sufficiently restrictive, look to see what happens, and sure enough, inflation's coming down, both the headline measure and the core measure. So it seems as if they think that this is a sufficiently restrictive rate. At least those are the hints he was giving at the December meeting. Then the third question is when to dial back policy. When is the medicine working? And when are you going to put the punch bowl back into the party? But the sentence which seemed to get everybody's attention was this one during the press conference. Powell said the question of when it will become appropriate to begin dialing back the amount of policy restraint in place, i.e. when we come to stage 3, that begins to come into view and is clearly a topic of discussion out in the world, with lots of journalists of course, and also a discussion for us at our meeting today. So they are starting to talk about it, whereas previously, allegedly, they weren't talking about it at all. And you can see the market reaction was very rapid and very extreme. The Nasdaq tech stock index rallied in the United States, so did the S&P 500, but so did bonds, both junk bonds, that's the HYG ETF, and US Treasuries. So yields fell and bond prices rose. So every asset class was cheering in response to this new news from the Federal Reserve. And they took this to be very dovish, in other words, hinting that interest rates are about to be cut. Now, finance is a bit of a dry subject, and often it's useful if you've got some other way of learning, which involves a bit of humour, so we do try to pack that into our weekly market roundup. This is delivered to your inbox every Friday as soon as we finish writing it. We'll never spam your inbox, and we always try to keep it short, punchy, and entertaining. So if you do want to learn the relationship between macroeconomics and markets and how the two relate to one another, but also get a bit of humour injected into your life, take a look at our weekly market roundup. You can learn more about that using the link in the description below. But is this a case of bad Santa? In other words, has Jerome Powell started to act against the interests of the overall economy and perhaps not in the interests of markets either? And he's done this by hinting that rates were going to be cut. Certainly Robin Wigglesworth from the FT seems to think so in an article which he wrote, which was called "This is a Bad Santa Rally." His point is that a lot of the assets which have rallied the most have been low quality assets. You might call this a flight to In other words, the stocks which have the lowest quality and which have really dodgy balance sheets, profitless tech, the most shorted companies, all of these were the types of stocks that rallied when news of lower interest rates hit the wire. However, I think this mischaracterizes the assets which actually rallied. If you look at the United States at the moment, the stocks which are most overvalued are the mega cap growth stocks, things like the Magnificent Seven. If you look at small caps in the United States, they're really beaten up and the valuations there look much more reasonable. That's why I bought small caps as part of my fund portfolio earlier this year. However, if we break down the rally since the Fed spoke, and this is roughly over a 1 week period, you can see that the factor or style of investing that has rallied the most has been small caps, whether that's small cap value, small cap core, or even small cap growth. All of those have rallied the most compared to other styles of investing. Now, it is true that quality is near the bottom of the table, so perhaps there is a slight element of a flight to here, but it's not a huge tilt. I'd say it's much more about small caps rallying rather than just junk stocks. So if we show that as a time series showing this week-long set of returns, and we contrast two funds, the first one is IWN, which is small cap value, and that's rallied by over 6% since Jerome Powell spoke. Whereas the other heroes of 2023, which is large cap growth, these are stocks like Apple and Microsoft, that factor is only up by just over 3%, half as much. And looking across sectors, you can see that it's very much defensives which have lagged, things like utilities, healthcare, consumer staples, and interest rate sensitive sectors like real estate certainly cheered what Jerome Powell was saying. Energy and consumer discretionary also were beneficiaries of his statement. So where does that leave us now overall for the United States in terms of valuation? If we look at the forward price to earnings multiple, we're now above the 5-year average. We're nowhere near where we were in the 2020 rally, the pandemania rally, when caution was thrown to the wind and valuations went crazy. But it's certainly now the case that US stocks are starting to look a little bit toppy. And that's a problem because when stocks get ahead of profits, that usually means a reckoning later on. It certainly means lower returns looking forward. So if you look at the dot plots, these are the forecasts from the FOMC members about where their policy rate will be in future. It's not a proper forecast, it's just a summary of what they think individually. But if we summarize those dot plots, and again what we've got here are bar plots for each of the periods for the end of 2025, the end of 2026 and 27. What I've also superimposed is a red dot, which is what markets think is going to happen to the Fed's policy rate. Notice the big disconnect now between the end of 2024, according to markets, and what the FOMC said just a week ago. Markets are much more dovish. They think that the policy rate's going to be much lower. They think the first cut is going to come in March, when if you listen to what the Fed says, that's actually quite unlikely. So it does strike me that markets have got a little bit carried away towards the end of 2023. It is nice to see these Santa rallies, but it's always nice if they are justified by really strong earnings growth. That's not what we see. This is a re-rating rally, and it is just a matter of people, I think, feeling happy towards the end of the year and overreacting to what the Fed has said. Where will policy be over the course of 2024? Well, if we believe the Fed, then it's probably later into the year when we get the first rate cuts. The FOMC is pricing in 2 cuts over the course of next year, and I think that'll probably come towards the middle or towards the end of the year. But when it does happen, we've seen that small caps probably will benefit from that cut, and also, of course, cyclicals and real estate, all of the interest rate sensitive parts of the US market. But is this a rally which is justified? Is it sustainable? Probably not. Now don't forget, if you do enjoy our videos, please do subscribe to our channel and like this video. And as always, thank you for listening.